Named after American economist Hyman Minsky, a Minsky Moment describes a sudden market collapse following an extended period of prosperity and reckless risk-taking. The tipping point occurs when an asset bubble bursts, causing widespread financial panic and often triggering broader economic crises. Minsky's insights, developed over several decades in the mid-20th century, gained renewed attention during the financial crises of 1998, 2007, and more recently during the pandemic. His work differed from classical economics, which assumed that markets, left alone, would correct themselves efficiently. Instead, Minsky argued that stability in the economy leads investors to assume greater risks. In his view, during periods of economic expansion, optimism grows, lending standards loosen, and more speculative financial practices take hold. In fact, Minsky argued that periods of economic stability and growth actually lead to complacency and are themselves destabilizing. He said there were three distinct stages of financing through which economies go prior to a Minsky moment. In the first stage, borrowers are cautious. Both interest and principal on debt is repaid using the cash flow from projects and investments. At this stage, debt is sustainable and risks are controlled. In the second stage, as the economy grows, confidence rises, and borrowers start to take on interest-only loans with the intention of rolling over principal payments indefinitely. This is speculative finance, an acceptable level of risk if economic conditions remain stable, but risky if things go pear-shaped. Finally, in the third stage, borrowers become overconfident and take on debt which they intend to repay by flipping assets for a profit, otherwise they cannot cover principal or interest payments. This stage is known as Ponzi finance, appropriately named after the Italian-American con artist who promised incredible returns but relied entirely on the perpetual inflow of new investor money to make payments. Similarly, the Ponzi finance stage is entirely reliant on continued price rises. This final stage is highly vulnerable and unstable. Minsky's main premise is that stability breeds instability. After a prolonged period of economic calm and rising asset prices, excessive risk accumulates in the system. This sets the stage for a Minsky moment. And the Minsky moment usually occurs as soon as asset prices stop rising, typically due to some external shock or a loss of confidence. Suddenly, debts can no longer be rolled over. As borrowers are forced to sell assets to cover their liabilities, prices plummet, triggering a feedback loop of panic selling. What starts as a small correction in asset prices quickly spirals into a full-blown financial crisis. Many of the crashes we see can be classified as a Minsky moment. They usually appear obvious with hindsight, but were generally unforeseen until they occurred. Some well-known examples include the 1929 Wall Street crash, the 1990s Asian financial crisis, the year 2000 dot-com bubble burst, and the 2008 global financial crisis. However, there are times when other factors are responsible. Events crashes, such as the 2020 COVID crash and 1970s oil crisis, were not Minsky moments. They were triggered by economic shocks not generally related to bubbles or excesses. So given what we now know, are we at risk of a Minsky moment today? And if so, where is it likely to begin? Well, as we like to say, no one can predict the future, least of all economists, but I do think the answer to those questions are very definitely and almost anywhere. After 40 years of falling interest rates and rising debt, the global economy now has unprecedented levels of debt at every level and in every region. For individuals, corporates and sovereigns, and from the US to Europe and China, and almost everywhere in between. Leverage has increased as interest rates have fallen, and liquidity from central banks has increased. Unprecedented US federal debt to GDP levels have started to rise again, after a very brief pause. And just as we would expect at the Ponzi stage, there is very little discussion about how this debt will be repaid. Asset prices have similarly been boosted by lower interest rates. The Schiller Housing Index has easily surpassed its 2008 levels, while the S&P Composite CAPE ratio shows that the index is trading on a valuation that is more than 2 times its historical average, 13% above the Wall Street crash levels, and at a level that has only been surpassed once, briefly, during the year 2000 internet bubble. But increasing debt growth and increasing asset prices cannot continue indefinitely. The fortuitous circumstances that have allowed such a broad upswing have proven to be remarkably long-lasting. However, globalization, lower inflation, and lower interest rates already appeared to have peaked before Donald Trump came to power, and the recent global tensions and the introduction of tariffs look set to hasten the demise of this golden period. as global supply chains are disrupted and inflation looks likely to increase. Interest rate swap costs are rising again, and if that becomes permanent, then it could very well be the catalyst that leads to a sharp drop in asset prices. That is depressing news indeed. But let me add one last takeaway. The irrational exuberance of these times is often founded on periods of remarkable economic change. Whether it's the internet boom of the 90s, the electrical and auto industry boom of the 1920s, or the railway boom of the 1800s, stocks eventually recover and the economy moves on to levels that were previously unattainable. So while the current froth around technology stocks and artificial intelligence does appear to be substantial, the real benefits that those industries could bring to productivity may eventually far outweigh any near-term bumps in the road. A link for the next video should be on your screen now. I hope you enjoyed this video. If you did, then please like, subscribe, and comment. Thanks for watching.